In just 3 months, one company added $1 trillion to its value, outpacing Amazon, Google, and entire nations by supplying 90% of the AI chips powering a $200 billion industry. The world now revolves around Nvidia's $3 trillion bet. But beneath the soaring numbers lurks a question nobody wants to ask. What if the spending stops? AI infrastructure spending crossed $200 billion in 2023, a sum that rivals the annual budgets of many countries. That figure is just the starting line. By 2027, projections put global investment at $600 billion, a tripling in only 4 years. The money is not scattered across dozens of suppliers or spread thin by competition. Instead, nearly all of it flows through a single channel, Nvidia. Estimates show Nvidia controls between 70 and 95% of the AI chip market, depending on which segment is measured. For data centers, the company's share is even higher, with 9 out of every 10 GPUs coming from their factories. The scale of this concentration is difficult to overstate. Microsoft, Google, Amazon, and every major player in AI are buying from the same supplier. These are not incremental upgrades or routine IT budgets. These are billion-dollar procurement cycles, with companies racing to secure enough hardware to keep pace with an industry that seems to double in ambitions every year. The result is a single point of dependency for the entire AI ecosystem. If the world's largest technology firms want to build, deploy, or expand artificial intelligence, they must go through Nvidia. Such a dramatic surge in capital, funneled almost exclusively through one company, sets the stakes for what happens next. The numbers are real, the spending is accelerating, and almost every dollar is a bet on the same supplier. The question is no longer how much is being spent, but what that BET means for the future of AI and for everyone betting on it. In 2016, Jensen Huang stood before Nvidia's board with a plan that would redefine the company's future. Until then, Nvidia's GPUs had powered video games and graphics workstations. But Huang saw something the rest of the industry missed. Deep learning was exploding, and Nvidia's chips, paired with its proprietary CUDA software, were proving unbeatable for training neural networks. Instead of chasing hardware sales alone, Huang doubled down on CUDA, Nvidia's own parallel computing platform. This was more than a technical upgrade. CUDA became the glue that bound developers to Nvidia's hardware, embedding millions of lines of code and years of expertise into a single ecosystem. Switching to a rival chip meant rewriting entire codebases, retraining engineers, and risking unknown bugs. For companies racing to build the next breakthrough in AI, that kind of disruption was out of the question. The result was a decade-long head start. By the time competitors like AMD and Google rolled out alternatives, the world's leading AI labs and cloud providers were already locked in. Nvidia's data center revenue soared 171% year over year, and profit margins climbed above 75%, numbers rarely seen outside monopoly conditions. Jensen Huang's CUDA bet did not just win the market, it made Nvidia nearly irreplaceable. As demand for AI hardware exploded, every dollar spent reinforced the moat. The more the world invested in CUDA, the higher the cost of leaving. That technical lock-in, built on years of deliberate strategy, is why Nvidia stands alone at the center of the AI gold rush. Training a frontier AI model is no longer a software challenge. It is a hardware arms race measured in racks and megawatts. When OpenAI set out to build GPT-4, they did not just need smart engineers, they needed an army of silicon. The final tally, about 25,000 Nvidia GPU units, each one custom-built for deep learning and priced between $10,000 to $40,000. That puts the hardware bill for a single training run in the hundreds of millions of dollars before accounting for energy, cooling, and the teams required to keep it all running. The numbers only grow from there. Google and Meta each manage clusters that reach into the hundreds of thousands of Nvidia chips. These are not theoretical deployments. They are physical fleets, ordered in bulk, often delivered months late due to overwhelming demand. For a company like Microsoft, a single procurement cycle can mean spending billions of dollars in one go, just to secure enough hardware to keep their AI ambitions on track. Each individual GPU is a marvel of engineering, but at these scales they become commodities, rows upon rows of identical cards stacked in data centers from Iowa to Singapore. The economics are relentless. A single H100 chip might cost $30,000 at list price, but secondary market shortages have pushed prices far higher. For startups and smaller labs, the barrier to entry is now measured not just in talent, but in the ability to outbid giants for the same finite supply. The result is a world where the size of your AI model is directly tied to your purchasing power. Every breakthrough, every new model begins with a negotiation for hardware. And right now, almost every check is made out to Nvidia. Microsoft invested $13 billion into OpenAI, but the money did not sit in a bank account or trickle slowly into research. Instead, nearly all of it flowed straight to Nvidia, as OpenAI placed orders for thousands of high-end graphics processing units. The story repeats itself across the industry. Google puts capital into Anthropic, and Anthropic turns around and buys massive clusters of Nvidia hardware. Amazon's AWS division, racing to offer the most advanced AI services, locks in contracts worth billions of dollars with Nvidia for the chips that power its cloud. This is not just a series of isolated purchases, it is a closed loop, one where tech giants fund AI labs, the labs spend their cash on Nvidia hardware, and Nvidia's soaring revenue and profits feed back into the stock market, lifting its valuation and making it even more essential. Every round of investment raises the stakes because every dollar spent on AI infrastructure comes back to Nvidia in the end. In 2023 alone, the combined spending by tech companies on AI chips and data centers surpassed $200 billion, more than the GDP of Portugal. By 2030, analysts expect annual infrastructure spending to top $1 trillion, with Nvidia capturing the lion's share. The more capital that flows through this system, the more entrenched Nvidia's position becomes. Each investment cycle reinforces the company's dominance, tightening the feedback loop and raising the risk that the entire AI ecosystem is betting on the same outcome at the same time. Warnings of overbuild are surfacing across the industry. In 2025, Microsoft, Alphabet, Amazon, and Meta all trimmed their infrastructure spending plans. Microsoft's capital expenditures, once climbing at double-digit rates, are now projected to fall by nearly 10% from the previous year. Alphabet paused new data center builds in North America and Europe. Amazon and Meta both shifted from aggressive expansion to a focus on efficiency, with Amazon's AWS division pulling back on new construction in key regions. Lead times for Nvidia's flagship chips, which stretched up to 9 months during the buying frenzy, have shortened to under 4 months as orders slow. AI startups that once raced to lock in hardware are now deferring or canceling purchases. A former Global Crossing executive, reflecting on the dot-com fiber collapse, called these trends eerily familiar. Capital pouring in, then a sudden turn toward caution as growth projections cool. Solar energy once promised to transform the world, but a single point of failure can unravel even the boldest vision. In 2011, Solyndra collapsed after supply bottlenecks and over-reliance on a fragile supply chain, wiping out hundreds of millions in investment. Today, Nvidia's grip on the AI market rests on equally narrow foundations. Over 70% of TSMC's advanced chip packaging capacity is booked for Nvidia, and the specialized memory, HBM, needed for each GPU faces lead times of 6 to 12 months. A disruption at any step, from TSMC's fabs to HBM suppliers, could stall global AI progress for months or even a year. The risks do not end at the factory floor. Passive funds now hold over 1/3 of Nvidia's stock, with Vanguard, BlackRock, and State Street controlling nearly 30%. If Nvidia's value falters, the ripple could sweep across every major index fund, affecting millions of investors in a single blow. Today, over $1 in every $15 of the S&P 500's value is tied to Nvidia. As markets lean on a single pillar, fragility grows. If AI fulfills its promise, fortunes are made. If not, the shockwaves won't stop at Wall Street. The future now balances on one chipmaker's bet: